Let's demystify bonds. Imagine lending $100 to a friend. They promise to pay you back in a year plus $5 as a thank you. That's a bond. In finance, you're lending to companies or governments, not friends. They use your money to build things and pay you interest for the loan. When you buy a bond, you're a lender, not an owner. The issuer promises to pay you back on a set date, the maturity date, and gives you regular interest payments, called coupons. Think of it as a predictable paycheck for letting them borrow your money. Big companies like Apple or governments like the US issue bonds to fund projects. Even your city might issue bonds to build a new park. The appeal? Reliability. Bonds are the steady, predictable part of an investment portfolio. You know how much interest you'll get and when you'll get your money back. That's why bonds are popular with retirees and new investors alike. They're not flashy, but they're foundational. Understanding bonds is your first big step toward building wealth. It's simple, steady, and smart. Ready to learn how bonds make you money? Bonds pay you in two ways: interest and the return of your original investment. Buy a $1,000 bond with a 5% coupon, and you'll get $50 a year, usually split into two $25 payments. This continues until the bond matures, whether that's 1 year or 30. At maturity, you get your $1,000 back. So, you collect interest along the way, then get your principal returned at the end. For example, if your city issues a bond to build a library, you buy in, get steady interest, and after 10 years, your money comes back. Bonds can also be traded. If interest rates rise, your bond's price might drop. If rates fall, your bond could be worth more. But for beginners, the simplest move is to buy and hold until maturity. You get predictable payments and your money back, no surprises. That's the core of how bonds make you money. Simple, steady, and reliable. Now, why are bonds perfect for beginners? Investing can feel overwhelming, but bonds offer safety. What pros call capital preservation. Unlike stocks, bonds are loans with a contract to be repaid, making them less risky. This means less stress and a stable foundation for your portfolio. You don't need to watch the market daily. You know when and how much you'll be paid. For beginners, the easiest way to invest is through bond funds or ETFs. Baskets holding many bonds for instant diversification. If one bond defaults, it barely affects you. You can buy these funds through any major brokerage. Just search for a bond ETF like BND and click buy. Start with any amount you're comfortable with. No need for thousands. Open a brokerage account, fund it, pick a diversified bond fund, and you're set. It's that easy to become a bond investor. Bonds help you build confidence and avoid rookie mistakes. So, how do bonds fit with stocks in your portfolio? Stocks and bonds aren't rivals, they're teammates. Stocks are ownership, high risk, high reward. Bonds are loans, lower risk, steady income. If a company fails, bondholders get paid before stockholders. Bonds protect your capital and smooth out the wild swings of the stock market. The trade-off? Bonds usually earn less than stocks over time, and inflation can eat into returns. That's why you shouldn't put all your money in bonds, especially when you're young. The best strategy? Balance. Use both stocks and bonds for a strong portfolio. Start with a simple, low-cost bond ETF to learn the ropes. Invest regularly, stay consistent, and keep learning. Bonds give you stability. Stocks offer growth. Together they build a solid financial future. Start today, your future self will thank you.